Welcome back to The Explainer. Today, we're strapping in for a deep, data-driven analysis of a major upcoming market event. We're looking at the Caliber Mining and Logistics IPO. We're going to break down the hard numbers, pick apart the underlying business model, and look at the macroeconomic forces at play here, all to help you understand exactly what this company is bringing to the public market. So, the big question we're answering today is simply this: should Caliber Mining actually belong in your portfolio? We are looking at a 450 crore rupee issue here. And well, as focused investors, we need to know exactly what we're buying into, right? Are we looking at a rock-solid foundation for long-term growth, or are there hidden cracks in the business model that we need to worry about? Okay, let's dive into this. Here's our roadmap for today's analysis. 1. Operations and industry outlook. 2. IPO details and objectives. 3. Financial performance and health. 4. Valuations and peer comparison. And finally, 5. Key risks and verdict. Section 1. Operations and industry outlook. The foundation. Now, the really crucial point here is that Caliber Mining, which was incorporated back in 2014, is a fully integrated services provider. They don't just dig holes, they manage the entire coal value chain. We're talking overburden removal, actual coal extraction, loading, unloading, plus both road and rail logistics coordination. And they execute the whole shebang across Maharashtra, Madhya Pradesh, and Chhattisgarh. But here is their real, undeniable operational advantage: their massive fleet. They operate an absolute arsenal of 1,911 vehicles and heavy machinery. I mean, to put that in perspective, if you parked them bumper to bumper, that is literally miles upon miles of excavators, loaders, and tippers. They've got the serious physical muscle required to execute large-scale contracts. But, and this is absolutely critical, it's very important to note that they do not own the mines themselves. They are strictly a contract service provider. And this brilliantly illustrates the macroeconomic tailwinds driving demand in their target industries. Look at the projected robust growth of iron ore demand in India. It's expected to reach a massive 437 million tons by 2031. To picture the sheer weight of 437 million tons, imagine stacking up the Empire State Building over 1,000 times. With India's infrastructure and steel production booming like it is, the demand for coal and minerals, and crucially, the logistics to actually move them, is structurally very, very sound. Caliber's positioning itself right in the middle of this rapidly expanding ecosystem. Moving on to Section 2, IPO details and objectives, the mechanics. All right, let's get down to the hard facts for this July 2026 offering. Mark your calendars. The IPO opens on July 17th and closes on July 21st, with a target listing date of July 24th. The price band is set between 402 and 424 rupees per share. For retail investors, the minimum lot size is 35 shares, which translates to a minimum initial investment of 14,840 rupees. The total issue size is a pretty substantial 450 crore rupees, which comprises a 400 crore fresh issue and a 50 crore offer for sale by promoters' shareholders. Now, as investors, we always have to ask the golden question: what is the company actually doing with this fresh capital? Well, out of the fresh issue, 208 crore rupees is specifically earmarked for debt repayment. Why does this matter to us? Because it directly improves their balance sheet health. By reducing that debt load, they significantly lower their finance costs, and that translates to immediate bottom-line profitability. Another 167 crore rupees will go toward capital expenditure to buy even more commercial vehicles and machinery to expand that massive fleet we talked about just a minute ago. The remainder goes toward general corporate purposes. Okay, Section 3, financial performance and health, the growth engine. Check out this revenue trajectory. Over the last 3 fiscal years, from FY24 to FY26, Caliber's revenue hasn't just grown, it's practically accelerated. They went from just over 953 crore rupees in FY24 to a staggering 1,677 crore rupees in FY26. That is an incredibly impressive 32.67% compound annual growth rate. They are scaling their operations rapidly and effectively, proving for sure that they can win and execute on those massive contracts. But look, as any smart investor knows, top-line revenue only matters if it actually translates to the bottom line, right? And for Caliber's profit after tax, or PAT, rose from roughly 95.9 crore in FY24 to 157.9 crore in FY26. Guys, that's a jump of over 64%. It shows that Caliber isn't just out there winning contracts for the sake of boosting revenue. They're executing them efficiently and maintaining their capital efficiency while they rapidly scale up the business. Which brings us to Section 4, valuations and peer comparison, the benchmarks. Now, what's really interesting here is the immense profitability gap in the data. EBITDA margins are a fantastic measure of operational efficiency, especially in super capital-intensive industries like mining and logistics. So the peer average for FY24 and FY25 sat between 11.3% and 12.5%. Competitors like BGR Mining and AMPL Resources, they're hitting the 15 to 19% mark. But Caliber Mining, they are operating at an industry-leading 24.5% to 25.7% EBITDA margin. That is a massive, massive advantage in operational efficiency over everyone else in their peer group. Caliber just stands head and shoulders above the rest of the pack when it comes to those margins. They're literally extracting more value out of every single rupee earned. And this is highly likely due to their integrated end-to-end model and their in-house maintenance capabilities. That combo just gives them much tighter cost control over their entire fleet. And that brings us directly to the valuation. Based on their earnings, Caliber is coming to market with a price-to-earnings or PE ratio of 15.02. For retail and institutional investors alike, this number firmly anchors the valuation discussion. It gives you a clear, standard metric to gauge whether you feel you're paying a fair price today for their robust historical earnings growth and those industry-leading margins.
Finally, Section 5, Key Risks and Verdict, the final weigh-in.
Now, listen closely. If there is one data point in this entire analysis that should make you hit the pause button, it's their extreme customer concentration. In FY26, 44.16% of their revenue came from northern coalfields and 40.95% came from western coalfields, meaning over 85% of their entire revenue is tied directly to just two subsidiaries of Coal India Limited. That is putting a lot of eggs into very specific baskets. If anything disrupts those relationships, or if those entities suddenly change their outsourcing policies, Caliber's top line is going to take an immediate and severe hit. So let's bring it all together into a completely neutral SWOT summary. On the strength side, they are undeniable. A fully integrated operational model, a massive active fleet ensuring they can actually execute, and industry-leading EBITDA margins. They execute efficiently and highly profitably. But on the threat side, the risks are equally stark. That extreme customer concentration we just discussed, the inherent volatility of relying on winning future tender-based contracts, and a high exposure to fuel and machinery costs in a very capital-heavy business. As for the overall market sentiment out there, third-party analysts are weighing these exact factors very closely. According to a review from Chittorgarh, they state, well-informed investors may park funds from medium to long term. Look, we are presenting this strictly as independent reporting from the source material, definitely not as an endorsement of the stock. But it does reflect one perspective, that investors who fully grasp the risks might just find value in Caliber's growth trajectory over a more extended horizon. Which leaves us with the ultimate question for you to consider for your own portfolio. Does the reward of Caliber's industry-leading margins and massive revenue growth outweigh the severe risk of their heavy customer concentration? That's the puzzle you need to solve. Take these numbers, dig into the red herring prospectus yourself, and do your own thorough due diligence. Thanks for joining me on The Explainer, and happy analyzing.